Welcome to the MUFG Global Markets Asia podcast. I'm Lloyd Chan, Senior Currency Analyst with the MUFG Global Markets Asia Research Team. The following podcast is for informational purposes only. It is intended for professional investors and eligible counterparties, and not for retail clients. Any content should not be regarded as an offer to conduct investment businesses or investment recommendations. For this episode, we will assess our outlook for Malaysia's economy and the ringgit for the rest of this year. The recently concluded US-China trade talks in London mark a constructive step forward in US-China trade relations, but the outcome, essentially a framework to implement what was already agreed in Geneva in May, falls short of being a strong catalyst for FX markets. However, President Trump's latest remarks on unilateral tariffs have added to the trade uncertainty, exerting downward pressure on the US dollar and offering support to regional currencies. Earlier comments from Treasury Secretary Scott Bessent suggesting a possible extension of the 90-day pause on reciprocal tariffs for countries negotiating in good faith will further shore up market sentiment and lend support to Asian currencies. So, despite lingering trade uncertainty, Malaysia's domestic economic resilience will be a key theme. Sustained investment momentum will help cushion the impact of external headwinds. We expect the ringgit to remain supported, underpinned by a softer US dollar, easing trade tensions, and robust domestic investments. Year to date, the ringgit has appreciated over 5% against the US dollar, outperforming the Bloomberg Asia Dollar Index, which has gained about 3.6% over the same period. Indeed, Malaysia's economy continues to show signs of strength despite ongoing global trade uncertainties. This is largely due to a robust domestic-led investment upcycle. This trend, which began in early 2024, has extended into 2025. Fixed investments rose 9.7% year-on-year in Q1, well above the pre-COVID average pace of 2.3%. Even as investment growth had moderated slightly from the 12% pace in Q4 2024, it had continued to outpace private consumption growth of 5%. Fixed investment contributed a solid 2.1 percentage points to GDP growth in Q1, up from the 0.6 percentage point average during 2015 to 2019. The fixed investment share of GDP has also risen to 22.5% in Q1, up from a low of 19.7% in 2022, when the economy was still recovering from the COVID pandemic. The investment momentum has been driven by both public and private sector projects, with total approved investments jumping 16.5% in 2024 to about 370 billion ringgit, representing an 83% increase over pre-pandemic levels. Importantly, domestic investors are leading the charge, helping partially offset the impact from delays and cancellations by export-oriented firms amid global uncertainties. Malaysia's policy-driven investment strategy remains a key pillar of growth. Key initiatives like the Johor-Singapore Special Economic Zone and Sarawak's Hydrogen Hub are emblematic of Malaysia's investment strategy. Johor, in particular, is emerging as a regional data hub, accounting for about 25% of approved manufacturing projects in Malaysia in 2024. One standout trend is the surge in ICT investments, which made up over one-third of total approved investments in 2024, up from just 4% in 2019. Domestic players led the way, accounting for more than half of approved ICT investments, while foreign direct investment in the sector grew 30% year-on-year. This investment boom will also be sustained by faster inventory drawdowns and above-average capacity utilization rate in domestic sectors, signaling the need for further investment to expand domestic productive capacity. However, downside risks remain. Malaysia's external sector is still vulnerable to renewed US-China tensions. Exports to the US affected by tariffs account for about 9% of GDP, while Malaysia's deep integration with China's supply chain adds further risk exposure. Sectors like optical equipment, machinery, and electrical goods are particularly at risk. Malaysia has been engaging with the US with the hope that it could avoid the full 24% reciprocal tariffs announced by Trump on US Liberation Day, but the current 10% baseline US tariffs are likely to remain in place. Meanwhile, the US is pushing for Malaysia to address the $25 billion trade deficit it has with Malaysia, reduce non-trade barriers, and implement safeguards for American technology. We initially expected a policy rate cut in the second half of this year. At the 8 May policy meeting, Bank Negara Malaysia adopted a more dovish tone, departing from its previous neutral stance. However, following the US-China tariff de-escalation on the 12th of May, just 4 days after that meeting, we believe Bank Negara Malaysia could afford to remain patient and maintain its policy rate whole through the rest of this year. Nonetheless, the central bank retains policy space to ease if needed. Headline inflation moderated to just 1.4% year-on-year in April, while the ringgit has strengthened year-to-date. The central bank's dovish rhetoric in May also signals its readiness to act should growth weaken materially. The central bank acknowledged that the growth outlook is tilted to the downside, citing risks from trade tensions and a potential deeper slowdown among key trading partners. While the central bank expects growth to come in slightly below the 4.5% to 5.5% forecast range for this year, it has held off revising its official outlook for now, pending greater clarity on the direction of US trade policy. Meanwhile, ringgit bonds also remain in high demand, with a strong 3.3 times bid-to-cover ratio for the 20-year government bond auction on the 30th of May, and rising foreign holdings of local government bonds. Foreign currency deposits also hit a record high of 11.6% of total bank deposits in April, adding to ringgit stability. In all, Malaysia's economy is navigating global uncertainty with a strong domestic investment engine. And while external risks persist, the structural shift towards high-value sectors and resilient capital flows offer a solid foundation for growth and the outlook for the ringgit in 2025. We look for dollar ringgit to consolidate at around the 4.20 level for now, with potential for further modest strength in the second half of this year. Thank you for listening to the MUFG Global Markets Asia podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you subscribe to your podcast. Contact your MUFG sales representative for more information. Check back again for more insights from the Global Markets Research Team.